Financial exchanges and stockbrokers are two companies that you're likely to come across if you're investing, especially in bonds or shares. So it's important to get your head around what they do. Think of a financial exchange like Bondi markets. Fashion and jewelry stores pay a fee to the organizer to set up their stalls. When the market opens, then the businesses can start selling their goods to buyers who visit the market. And at the end of the day, the market closes and trading stops. The same thing goes for a financial exchange. Companies who want to list shares pay a fee for a spot on the exchange. When the market opens, shares can be traded between buyers and sellers, and at the end of the day, trading stops. The only difference is that in the Bondi markets, the buying and selling happens directly between the store owner and the customer. On a financial exchange, companies sell their shares to very wealthy investors, which is the primary market, who then sell them to the average investors, which form the secondary market. The majority of shares available are then traded between these investors in this secondary market. This means that when an investor is buying shares, the chances are that they're actually buying them from another investor and not the actual company issuing the shares. Okay, so now we can introduce the role of the stockbroker. You see, because most investors are buying and selling shares on computers these days, they don't know who they can buy from and who they can sell to. So a stockbroker becomes the middleman who can connect buyers and sellers. Let's say that you have a buyer who places an order with their stockbroker for 100 shares at $30. And let's say that you have two different sellers, both for 50 shares at $30. The stockbroker will match the buyer with these two sellers to satisfy the orders of each person. An important thing to note with stockbrokers, though, is the concept of the bid and ask spread. So the example that I just presented before was a bit simplified and did not include this. So the buyer from before, who wants 100 shares at $30, will probably have to pay something like $30.10 for each share. This is called the ask price, which is the minimum price that the stockbroker will sell the shares for to the buyer. And the sellers who are trying to sell 50 shares at $30 will probably have to sell for something like $29.90 for each share. This is called the bid price, which is the maximum price that the stockbroker will buy shares from the seller. The difference between the bid and ask price represents the profit that the stockbroker makes for connecting the buyer and the sellers. In this case, it's 20 cents per share. Stockbrokers can also make a profit from the buyers and sellers on each order that is fulfilled, which is usually a fee of something like $15, depending on the stockbroker. This is called a brokerage fee. So that's a neat summary of financial exchanges and stockbrokers. If you're looking to invest, then make sure that you understand how both parties operate before you make further steps.